Let's wrap up our discussions about cost of capital here by discussing the marginal cost of capital. So far we've talked about a weighted average cost of capital, but there are instances where it may get more expensive to raise additional funds. So it might be that the first dollars we raise, we can raise at fairly low cost, and as we try to raise more money, the costs go up. So for example, you might go borrow money from your parents when you're in need of, when you need some capital, when you need some money. You might go to your parents first, and they might cut you a pretty good deal. After that, you go to your uncle, and his deal isn't quite as good, and eventually you're going to the bank to borrow money, and their deal isn't as good as your parents' deal. So in that same way, companies find their cheapest source of capital first, and then as they try to raise additional capital, it frequently gets more expensive. At least initially, the company is going to use equity capital with retained earnings, but retained earnings isn't a limitless pot of funds. You only have as much retained earnings as the company has been able to generate in the past, and so there's a limit. That's the fundamental idea. There's a limit to how much retained earnings you have, but you might have investment opportunities that exceed your ability to fund these projects internally. So what would the firm do? Well, they might choose to issue additional stock. So let's look at a situation where the firm might do that. In this case, our assumptions are that 60% of the amount of equity capital is what the firm needs to maintain. So our weighted average cost of capital is minimized at a 60% equity capital, 40% debt level. And Baker Corporation has $23.4 million in retained earnings. Retained earnings in common stock that it already has. So what is the size of the capital structure that the firm can support under that situation? Well, we can find that. That's this value X that is solved by dividing the retained earnings by the percentage of retained earnings in the optimal capital structure. And so in this case, down here along the bottom, we have $23.4 million. We want to maintain a capital structure with 60% equity. That means that we can support a firm capital structure of $39 million. If we had $50 million of projects that we wanted to support, the first $39 million could be financed using common equity, which we found earlier had a cost of capital of 12%, and we've been using this average cost of capital, weighted average cost of capital of 10.41%. But if we have to issue new stock for an additional $11 million in projects, the new stock is going to cost us more. It's going to cost us 12.6%, so that our overall weighted average cost of capital, which is now designated with a KMC, all right, K cost at the marginal cost, the average cost, but we're talking about really the marginal cost of capital, which is now 10.77%. So we now have two different costs of capital. KMC represents the marginal cost of capital if we have to raise new funds, and the marginal cost of capital is higher because retained earnings cost us less to reinvest. There's no flotation cost. After we have to issue additional shares, we have some flotation costs that are involved, and the cost of new equity financing goes up. Let's look at what well, before we look at it any further, recall the way we got this new cost of capital for equity. K new was our cost of equity that came out of the constant growth model valuation method, but now we had flotation costs, and And we spoke about this earlier in the chapter, and actually generated this 12.6%. We'll come back to Z in a moment. If we had $50 million in potential projects that we were interested in taking, all right, 50 million here, we might find that at our current cost of capital, we can only take 10.41, even though Project E had a cost of capital below 10.41. It isn't a high enough cost of capital to pay for the new financing that we're going to have to overcome. So it really, this is a picture of the observation that we're going to rank order our investments, and the quality of our investments keeps getting poorer, but the cost of our new investments keeps going up, and so we have to balance those two issues. We can carry this example just a little farther and see that we might also be forced to issue new debt. So we could go through the same process of identifying how much debt we could, or the size of the capital structure that we can support with cheap debt. And let's imagine that we can raise $15 million of debt at one cost, and then if we're going to raise additional debt, the cost is higher. Well, what's the total capital that we could support? Well, given that we want to have a capital structure that's 30% debt, we divide the $15 million amount that we could raise inexpensively, in other words, the cheap debt we could raise, divide that by the percentage of debt in the optimal capital structure, and we could support a capital structure of $50 million with relatively cheap debt. If we want to raise capital above $50 million overall capital, we're going to have to borrow money at a more expensive level. So that might be at our higher debt cost for amounts over $50 million. We might have a cost of debt of, say, 10.6%. And given that we already, at the, $39 million mark, had to raise new equity capital at 12.6, now our marginal cost of capital for amounts above $50 million are 11.23%. So overall, we come to the conclusion that if we have only $39 million of financing that's required, we can do that at 10.41%. Above that, we'll have to raise more equity, and the new equity, because of the flotation costs, will drive the cost of capital up to 10.77%. And then if we have to raise even more, the cost of the new debt that we're going to issue, because we've exhausted our cheapest sources of debt, might go up to 11.23%. So that brings us back to our little graph here that demonstrates both the changes in the marginal cost of capital at higher levels of capitalization, as well as the declining levels of profitability for individual projects. So as it turns out, we're going to accept projects A through D, and beyond that, the projects cease to make sense because the costs of raising the capital preclude taking on those projects, even though if we had enough capital that we generated internally and could be financed with the cheap debt, we might have chosen to take on Project E after all.